The Norwegian government pension fund Global, commonly called the Oil Fund, manages over $1.7 trillion in assets and is the world's largest sovereign wealth fund. It holds shares in over 9,000 companies across 70 countries. It has strict ESG requirements, detailed carbon emission screens, and a mandate to protect the long-term wealth of Norwegian citizens. And yet, through its holdings in companies like MicroStrategy, Coinbase, and Block, it has accumulated indirect Bitcoin exposure exceeding $500 million. The Canadian Pension Plan Investment Board, CPP Investments, made a direct $95 million investment in digital asset infrastructure in 2021 before writing down significant value in the 2022 collapse. These are not cautionary tales. They are case studies in how institutional fiduciaries navigate the tension between exploring a new asset class and protecting beneficiary capital. The frameworks they developed are the most sophisticated in institutional crypto. Pension funds operate under a fiduciary duty framework that is fundamentally different from endowments, family offices, or hedge funds. Fiduciary duty requires pension fund managers to act solely in the interest of plan beneficiaries, not to maximize returns, but to prudently manage risk-adjusted returns over long investment horizons. This creates a higher bar for any asset class that lacks established valuation frameworks, deep liquidity, or clear regulatory treatment. For crypto, the fiduciary question is not whether Bitcoin might go up. It's whether the expected risk-adjusted contribution to portfolio outcomes justifies the compliance, custody, and reputational risks of the allocation. The Norwegian and Canadian models both answered this question through the same structural insight: indirect exposure through compliant equity vehicles, miners, exchanges, blockchain infrastructure companies, delivers meaningful crypto correlation without the direct custody, regulatory, and fiduciary complications of holding Bitcoin directly. The institutional data on pension fund crypto exposure reveals a pattern of indirect and selective engagement rather than broad direct allocation. Norges Bank's fund holds over $500 million in indirect Bitcoin exposure through equity holdings in MicroStrategy, Coinbase, and other crypto-adjacent companies, none of it direct Bitcoin. CPP Investments made a $95 million direct investment in digital asset businesses in 2021 and subsequently took significant write-downs in 2022, making it a cautionary case study on direct allocation timing and due diligence in a nascent sector. The Ontario Teachers' Pension Plan invested $95 million in FTX equity at a valuation of $32 billion and lost the entire investment in FTX's 2022 bankruptcy, the single most prominent institutional crypto loss. Despite these setbacks, a 2025 survey by the Chartered Alternative Investment Analyst Association found that 37% of institutional investors globally had at least some crypto-related exposure, up from 22% in 2023. The Norwegian and Canadian models represent two distinct institutional approaches to crypto exposure that pension funds globally are now studying. Norway's approach is passive and indirect. The fund holds crypto exposure only through its broad equity allocation to companies that happen to operate in the crypto industry or hold Bitcoin. No active crypto strategy, no direct digital asset allocation, no custody infrastructure. The result is meaningful crypto correlation. When Bitcoin rallies, MicroStrategy and Coinbase outperform, without any of the direct regulatory, custody, or fiduciary complications. Canada's approach was more direct and more costly. CPP made active allocations to digital asset businesses and faced concentrated losses when the sector collapsed in 2022. The lesson most pension funds are drawing from the comparison is clear. Indirect exposure through listed equities provides adequate crypto correlation with dramatically lower operational and fiduciary risk. Pension funds face uniquely severe risk implications from crypto exposure compared to other institutional investor types. Reputational risk is primary. Pension beneficiaries, retirees and future retirees, are a politically sensitive constituency. A high-profile crypto loss generates newspaper headlines and political pressure of a type that endowment or hedge fund losses do not. Concentration risk was crystallized by the Ontario Teachers' FTX loss. A single direct venture investment in a fraudulent exchange wiped out $95 million and generated reputational damage orders of magnitude larger than the dollar loss. Regulatory risk for pension funds specifically includes ERISA fiduciary standards in the US and their international equivalents, which apply a higher standard of documented due diligence to alternative asset allocations than most crypto investments can currently satisfy. The Ontario Teachers' Pension Plan, managing $250 billion Canadian dollars for over 300,000 active and retired Ontario teachers, made a $95 million equity investment in FTX at a $32 billion valuation in late 2021 and early 2022. The investment was made through the fund's Teachers Venture Growth team, which focuses on late-stage growth and pre-IPO investments. OTPP conducted what it described as standard institutional due diligence, financial audits, management interviews, business model review. In November 2022, FTX collapsed due to fraud, misappropriation of customer funds, and fabricated financial statements. OTPP wrote off the entire $95 million. The case became the canonical institutional warning. Existing due diligence frameworks, designed for traditional financial institutions with regulated accounting and oversight, were insufficient for evaluating a crypto exchange with opaque internal controls and a charismatic but fraudulent founder. Pension funds building a crypto exposure framework should follow a four-step process designed around fiduciary standards and beneficiary obligations. Step 1 is mandate review. Confirm that the investment policy statement and beneficiary mandate permit digital asset exposure and document the fiduciary analysis supporting any allocation. Step 2 is exposure structure selection. Evaluate indirect equity exposure, ETF exposure, and direct allocation against the fund's custody infrastructure, regulatory posture, and risk tolerance. Step 3 is enhanced due diligence protocol. Apply crypto-specific due diligence that goes beyond standard financial audit to include on-chain verification, exchange proof of reserves, and custody architecture review. Step 4 is governance documentation. Ensure that investment committee approval, investment rationale, and ongoing monitoring protocols are fully documented to satisfy fiduciary examination standards. Pension fund crypto mistakes concentrate around three patterns that differ from general institutional mistakes. First, applying traditional financial due diligence frameworks to crypto ventures without crypto-specific protocols. Ontario Teachers' FTX loss demonstrated that existing audit and interview processes are insufficient for detecting crypto-specific fraud. Second, making direct allocations without building internal custody and compliance infrastructure first. The infrastructure required to hold digital assets safely under fiduciary standards takes 12 to 18 months to build properly. Third, anchoring position size to the dollar amount rather than the fiduciary headline risk. A $95 million loss in a $250 billion fund is 0.04% of AUM, but the reputational and political cost was orders of magnitude larger. The Norwegian and Canadian experiences collectively define the institutional frontier for pension fund crypto exposure. The lesson is not to avoid crypto. It is to structure exposure in a way that is defensible under fiduciary standards, politically durable, and operationally robust. Indirect equity exposure is the lowest friction path. Direct allocation requires significantly higher infrastructure and governance investment before it meets the fiduciary bar. Pension funds are navigating crypto exposure with the most stringent fiduciary standards in institutional finance. Understanding their frameworks is essential for any institution with similar beneficiary obligations. Subscribe to Crypto Mechanics for institutional-grade crypto analysis delivered weekly.